Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Tuesday, February 23rd, 2010. We would be selling stocks in anticipation of a more significant correction. We believe the S&P could visit the high 900s before resuming its long-term uptrend. Nevertheless, we would keep a bullish bias from a long-term perspective. Today's guest is Katie Stockton. Katie Stockton joined MKM Partners in August 2004. Prior to joining MKM, Mrs. Stockton worked as a trader for a New York-based hedge fund, Ulysses Management, and was a publishing analyst for Morgan Stanley's Technical Strategy Group. Mrs. Stockton's career began in 1997 in San Francisco, where she worked as a technical analyst for Witt Soundview. Mrs. Stockton received her Chartered Market Technician designation in 2001 and graduated magna cum laude with a BSBA from the University of Richmond. Katie Stockton, welcome to the program.
Thanks for having me.
Oh, we're just delighted to have you with us today. You know, I heard you speak at the MTA's May Symposium last year, and if I remember correctly, you're married and just had your first child. So you're married with a child. You've got an important position with a high-powered firm. You're really a Nietzsche superwoman, aren't you?
I don't know about that.
Before we get into things too deeply as far as technical analysis is concerned, why don't you share with some of our listeners who are in similar positions to you how you go about balancing your life, everything you've got going, and particularly with a new child in the family?
Well, the thing about working in the stock market, it's very difficult to take down your hours. I mean, you really have to stay very close to the market to be good at what you do as a technical analyst. So that's been important to me, to keep those same hours while striking a balance on the home front. You know, I do have a baby at home. She's about 14 months now, and fortunately we have a wonderful nanny that takes care of her during the day, and also fortunately I live just about 10 miles from work, so nice. I'm able to go home if needed and really stay in touch throughout the day. So that's fortunate, and it is all about keeping a balance and not working too late, or late in the evenings after she's in bed. I can go back and revisit the market if I've missed something during the day, but it is definitely walking a fine line there.
Mm-hmm. Good advice. All right then, let's get into a little history. Give us a couple minutes, 2, 3, 4 minutes, whatever you're comfortable with. What were you doing prior to technical analysis? How and when did you discover technical analysis, and how did you make the transition to a full-time technical analyst?
You know, I've actually always been a technical analyst from almost day one of my career. I got interested in it in college back at University of Richmond, which happened to be one of, I think, 12 universities at the time that had a program or had a class in technical research. Oh. At the time, it was a graduate level course. Yeah, it was. They would fly down people like Ralph Acampora and Phil Ross, all the big stars of technical research, and of course, they're very inspirational speakers as an impressionable college student. So even as an undergrad, I audited that course on the graduate level and found it, incredibly interesting. The way I really knew about it is because I was a finance major and just got wind of it that way. And I had an internship with a firm, actually it was Payne Weber at the time. And I remember one of the retail stockbrokers had on his desk some research, and it looked really interesting to me. It had X's and O's on it, and of course I later learned that was a point and figure chart, and it came from a local firm there in Richmond called Dorsey Wright and Associates, which I joined them as an intern for a couple of years. So throughout college, I was working as sort of an intern with Dorsey Wright, and learning about the technical research through that class. And that class actually at the time offered for the final exam the CMT Level 1. And that was also very fortunate. So I graduated with a CMT Level 1.
Wow.
And was placed out in San Francisco with a client of Dorsey Wright called McCullough, Andrews, and Cappiello. And Frank Cappiello was of the Wall Street Week fame, and I joined them as a technical research analyst doing point and figure charts. So that was how I got started with it all. And out in San Francisco, I sort of stayed on that career path. Jumped around a couple of times with getting licensed at DLJ for a period, but still always applying technical research on some level. Finally ending up at Soundview or Witt Soundview, which formerly was, interestingly enough, E-Offering. It was, the product of a merger there. E-Offering was the investment bank of E-Trade, and we did technical research for them for E-Trade and, focused primarily on the technology sector. And in the late 90s, as we know, focusing on the tech sector was pretty much a momentum story, and had some, good track record there. So that's how I got started with it and really just stayed with it throughout my career.
Wow, I really envy you your opportunity to be exposed to technical analysis while still in college. That was quite an opportunity. Why don't you, before we go on, why don't you give us an idea as to what sort of role the MTA has played in your career?
The MTA all along has really just been an incredible resource for me, not just for networking, but also for content. And it's been great to see it grow. It's amazing in this industry where you can have access to the people that created the indicators that you use. And that's what the MTA has offered to me, beginning in the early stages, obviously getting into the CMT program that gets you involved by default, but also just, attending the seminars and meeting people that really just had incredible valuable resources throughout my career. They've acted as resources to me, and we've kept those relationships going, and the MTA has been just invaluable in that sense. So they fostered, my CMT exam, and I wrote a research paper for CMT Level 3. That was back in 2001 when I received it, and I did it, about point and figure charting and volume, sort of incorporating volume to point and figure charts, which I thought would be interesting, and it was interesting. Of course, now I don't use point and figure charts anymore because it's not as practical for what I do. But nevertheless, I still believe that they're, very valuable. And again, it's one of those things that the MTA helped forward for me.
We're going to continue with Katie Stockton in a moment, but first a reminder that on next week's program, we'll have from Mizuho Bank in London, England, Nicole Elliott. Katie, let's go ahead and just answer that question I alluded to a moment ago. Tell us about your typical day.
The typical day here for me at MKM Partners, it's very front-end loaded, so very busy in the morning before the market opens. I publish research on a daily basis, so I have a written research report that covers typically sort of a top-down view of the broader equity market, including references to the dollar and some commodities and the 10-year Treasury yield, things like that, and also a lot of sector relative strength work on Mondays, so I feature that report then. And throughout the week, I supplement that report with sort of theme-based calls, many of which are derived from that sector relative strength analysis. So throughout the week, I have a report written each day. I do that throughout the day, and it's published at 5:30 every morning. And shortly thereafter, I get into the office and do a morning call here internally for our salespeople, our research sales and sales traders, and with a look at the market from a short-term perspective as well, looking at intraday charts and giving them a sense of the bias for the day or for the week, whatever is relevant at the time. And then later in the morning, I also distributed an email to clients that consist of just that, sort of a posture on the market for that day and some various signals based on counter trend indicators like the DeMark indicators, and then also feature some market internals like breadth and volume, things like that I think are relevant and important to stay on top of. So essentially there's a lot of writing and in the morning it's a lot of communicating with clients about what I've written and just making sure that it gets into the right hands, and of course sort of evaluating what the market's set to do that day.
You've told me previously that you sit on a trading desk, and I was under the impression that the typical consumer of your research were your fellow traders, but it sounds like it's much broader than that.
It is. So I sit on the trading desk really to be in the midst of the information, so that way I can hear what our trading desk is trading and be there as a resource for our traders. Essentially, though, our clients are primarily institutions, mutual funds, and hedge funds, some of which trade very actively, some of which don't. I speak to a lot of portfolio managers, traders, analysts about the market, again, varying time horizons depending on their preference, and also a variety of sectors and posturing, et cetera. So we can really hit on any cylinder because obviously, as long as something has a price, we can look at the chart and have an opinion. So in that sense, it's fortunate. But it's nice to be in that sort of information flow on the trading desk. So I couldn't imagine really being stuck in an office at this point because I'm so used to the noise and just really being in the mix.
Is that right? I wanted to talk to you about your use of Japanese cloud charts. Just an observation, but I mentioned a moment ago that next week we're going to have Nicole Elliott as a guest. And quite by coincidence, maybe I think our only two women guests in the several months we've been doing this, and I apologize to those who would like to hear from more ladies. But number one, it's interesting that both of you seem to put a real emphasis on cloud charts, and so I wanted to talk to you about that. You wrote recently, if the dollar can break out above monthly cloud-based resistance decisively, as it did last in January of 1997, it would suggest the uptrend will persist for several years. You obviously give cloud charts a great deal of weight. Can you tell us, first of all, how did you discover cloud charts? How did you decide that this was an important tool for you personally? What would you tell others about who are considering the use of cloud charts?
The cloud charts, I was enlightened to them by Rick Bensignor when I had my stint at Morgan Stanley. He was a user of the cloud chart and is definitely an expert in that arena. And they're not that widely followed here, as you know. So to me, it gives me an edge in looking at clouds primarily as an indicator of support and resistance in addition to the trend or the prevailing trend in a given security. So it really has been helpful in my work. I think the real edge is in, commodities and currency. So that's probably why you heard that conviction in regards to the dollar index. It tends to act very well or just be very reliable on those charts. And I think part of the reason is for the fact that these cloud charts are really widely followed overseas. In fact, I've heard that they're as widely followed, in Asia as we follow the 200-day moving average here in the U.S. So right or wrong, it definitely, they seem to work pretty well with these, sort of forward-looking support and resistance levels, including that in the DXY. And I'm rarely that long-term of a technician, but, when you do see a major shift like that, it bears highlighting, in my opinion. I don't know tons of people that use the cloud charts, but, it definitely seems to have it sort of a low-level following, and hopefully we'll get more traction and we'll see more literature out there about them.
Do you have any particular reading suggestions for those who might be interested, or is your knowledge all just from experience?
For me, it's mostly experience. I haven't done much reading on the subject just because it's not out there. I think there's probably more in Japanese than there is in English. I remember Stocks and Commodities magazine had an article. They did feature the cloud model at one time, and it does have a Japanese name that I would totally ask. Yeah. So I'm not gonna go there, but it stands for one look, and in that sense, it's a lot like candlestick charts, which also came from Japan, where it gives you just a nice visual picture of the trend. And, as it stands, we've seen, in the recent weeks, a lot of breakdowns below cloud-based support for the first time since early last year. So it really, helps sort of give me my tone from a top-down approach for the market when I work from a bottom-up perspective. I see all these breakdowns, and that helps shape my top-down perspective. Also with the major indices, I pay attention to it as well. But it just helps me get a feel for the market. I think Rick Bensignor either already did or is in the process of writing a book about them, so I would certainly keep my eyes open for that as well.
Okay. You talk about numerous breakdowns. That takes me right to my next point. You wrote, there are notable differences between the current correction and past corrections. Tell us about these differences.
Right. I'd say primarily the differences come from a breadth and sentiment standpoint. So looking at the market's internals, we saw breadth come off, and it really rings of mid-2004 to me. So in 2003, we saw a base breakout that I likened to what we saw last summer. The basing phases had different structures, but nevertheless, they were both very long-term in nature and impactful and yielded pretty impressive upside targets over the long term. So to me, that we didn't see a real correction after that mid-2003 base breakout until March 2004. And over that period, during that recovery rally, we saw the percentage of stocks above their 200-day moving average go from, the low single digits up to the, 80-90% range. And that's exactly what we saw during the recovery rally off of the March low, through January of this year. And so to me, we've seen it kind of fall off below its own 200-day moving average. So those similarities are something that we did not see back in June, July of last year, for example, when we saw, an 8 to 9% correction across the board. And that's the primary difference. And then also the sentiment readings did reach extremes or contrarian extremes in mid-January. So you saw, the spread between bulls and bears reach levels that were somewhat uncomfortable and that in some cases hadn't been seen since, May 2008 or, even earlier than that. So it was definitely, bear paying attention to. And I think it was more a lack of bearishness than it was excessive bullishness, but nevertheless it was out there.
You make it very clear in your research that you're short-term bearish but long-term bullish. And yet, when I dig into the details, and correct me if I'm wrong here, it sounded to me like you were really only targeting a 61.8% retracement of the most recent decline from October of 07.
Right. Through May or March of 2009, right?
Yes, thank you. Which really isn't that much further above where we were back January 19th. Am I misreading that, or is that to you? Is that the top? Or tell us what makes you long term?
No, I don't think that's the ultimate top, but that's my long term upside target based on the base breakout that we saw last summer, the one I was just discussing. So that same breakout projected target of that distance up to that 1220-1230 area. It also happened to be the 61.8% Fibonacci retracement of that entire decline, and also coincided with some former support levels. So to me, it had sort of triple importance there and was a natural place for the S&P 500 to gravitate towards off of that base breakout. By no means is it an ultimate target where I expect sort of another bear market top to be put into place, but rather I sort of reserve the right to revise that higher once once I feel more confident in the market, and that more likely will happen after we do see a short-term correction that's a bit more significant than what we've seen so far.
Here's a question that is shooting straight from the hip, so I'll try and make it make sense. When you see something like the 61.8% retracement level, and you obviously you can look at that, and we would all look at that and see resistance. To you, Katie Stockton, does that necessarily mean that is a magnet pulling price up to that level, or is it simply overhead resistance? It just can't. It's going to have a hard time getting through that level. Is there an attraction?
Yeah, in a way it is a magnet in that, obviously these Fibonacci retracement levels occur in, more than just the stock market, but also in nature, et cetera. And, it is a mathematical sequence. And it tends to happen when you retrace more than that first retracement, 38.2%, that you often see a 61.8% retracement at a minimum. So to me, it is a magnet in that, in that sense when you're paying attention to the Fibonacci elements of it. Otherwise, I would say it's, it's a target from the base breakout. So again, that would be more of a magnet versus just a resistance level. The resistance is more from those former lows. Looking way, way back. And I'm also of the camp that maybe you don't want to look too far back for support and resistance, because I don't think the market's memory is quite as long as it used to be given the increased volatility. So I'd be, cautious looking too far back for support and resistance levels for them to be valid. But nevertheless, it does project that target of 1220, 1230, so I'd look at it as more of a magnet.
Yeah, interesting. We're down to our last 1 minute, and I still have questions left. So very quickly, you're obviously a believer in Fibonacci and use that extensively from what I've seen. Fibonacci, of course, is a big part of Elliott Wave, and the consensus in the Elliott Wave community these days is that we've seen the top, but it doesn't sound like you would agree with that. Do you follow Elliott Wave? And if so, how do you normally use it given your out of consensus viewpoint with these folks?
Right, so I'm not a follower of Elliott Wave. I mean, I learned about it in the CMT program, so I definitely respect people that use it. I'm also not a Gann angles person or a cycles person really in general. My toolbox consists of, momentum indicators, including the cloud model, and also MACD indicator and a couple of moving averages that I prefer over others. And then also over bought over sold measures, and that includes the stochastics, which is a very common measure, although I feel like I have uncommon parameters in addition to the DeMark indicators. And then my final tool, and which really might be among the most important, would be relative strength comparative analysis, not to be confused with the RSI, looking at sectors primarily compared to the broader market. So when you see this sector relative strength emerge, it can give you clues, and that's where a lot of these great theme-driven calls come from, and where the great, ideas come from on the stock level as well.
Katie Stockton, it's been great having you with us today. You're like a fresh voice. Is there anything else you'd like to mention before we go?
Oh, gosh. Well, no, just to encourage people to stay involved with the MTA. I'm somewhat self-interested as the chairperson of the New York chapter, but we hold monthly meetings, and we have incredible people speaking to our group. In fact, in 2 weeks, we have Mike Santoli, who writes the Streetwise column for Barron's, coming to speak to our group. So I encourage people to stay involved and just keep learning, because even if you feel like you're set in your ways, there's a lot of great tools out there.
Oh, that's wonderful. Well, again, Katie Stockton, thank you for joining us today. That wraps up today's MTA podcast. From Seattle, I'm Ed Carlson. You can follow me at seattletechnicaladvisors.com or contact me at ed@seattletechnicaladvisors.com. Send us your comments and suggestions. Let's keep our stops tight. Good day.